Hi, welcome to BISP Solutions. Today we will understand the concept of working capital and liquidity analysis. Let's start.
Welcome to this explainer. I'll be your tutor today, and we are going to absolutely master working capital. More importantly, we're going to help you navigate right around those notorious CFA exam pitfalls that honestly catch way too many candidates off guard. Let's get right into it.
So, profit shows success, working capital shows survival. It's an incredibly powerful quote and a core truth in financial statement analysis. Think about it. You can have all the profit in the world on paper, but if a company literally doesn't have the cash flow to run its daily operations, well, it's going to fail, period. Today we're looking at the absolute lifeblood of a business.
All right, here's our study plan for today's session. Survival first, the formula toolkit, dodging CFA traps, a quick practice walkthrough, and finally some pro study tips.
Let's kick things off with Section 1, Survival First, where we'll be defining working capital.
Think of this as the bedrock of short-term financial health. Working capital is simply the short-term resources a company has available to run its daily short-term operations. Basically, it's the business's raw strength to manage everyday expenses. This ties directly into liquidity analysis and cash flow management. Trust me, if you don't grasp this baseline concept, the rest of the financial statements just aren't going to make sense.
Moving right along to Section 2, the Formula Toolkit. Let's build out the basics.
Okay, you absolutely need to lock down this core formula because you'll be using it constantly. On the asset side, we've got items like cash, inventory, accounts receivable, short-term investments, and prepaid expenses. Over on the liability side, we're looking at accounts payable, short-term loans, wages payable, taxes payable, and the current portion of long-term debt. The formula? It's a breeze. Working capital simply equals your total current assets minus your total current liabilities.
Let's anchor this with a real-world example so it really sticks. Let's look at Asian Paints. If they have 800 crore rupees in current assets and 500 crore in current liabilities, the math is super straightforward. 800 minus 500 leaves us with a positive working capital of 300 crore. What does that tell us? It indicates excellent liquidity, smooth operations, and a ton of financial flexibility. They can comfortably handle their short-term obligations without breaking a sweat.
Now here's where it gets really interesting and where context becomes absolutely vital. You might just assume positive is always good and negative is always a disaster, right? Well, not quite. Take a business like Reliance Retail versus a massive heavy manufacturer like Tata Steel. A retail company often collects cash super quickly from its customers, but they might pay their suppliers much later. In that specific scenario, negative working capital can actually represent a highly efficient business model. But if you spot negative working capital in a capital-intensive manufacturing company like Tata Steel, yeah, that's a massive red flag. It points to extreme liquidity pressure and potential payment defaults. So remember, context is literally everything here.
Let's jump into Section 3, Dodging CFA Traps. Welcome to the danger zone.
Listen closely, because this is exactly where the exam will actively try to trick you. Trap number 1, assuming higher working capital is always better. Completely wrong. If it's too high, it strongly suggests an inefficient use of resources, like maybe they're hoarding way too much obsolete inventory. Trap 2, thinking negative working capital is always bad. We literally just busted that myth with our retail example. Trap 3, completely ignoring the industry type. You just cannot analyze a fast-moving consumer goods company the exact same way you'd analyze heavy manufacturing. And finally, Trap 4, memorizing formulas without interpretation. If you just memorize assets minus liabilities but have no clue what that number actually means for a specific business, you are going to struggle with the conceptual questions.
All right, time for Section 4, Practice Walkthrough, where we'll be solving with a little AI help.
Let's put on our analyst hats and tackle an exact CFA Level 1 exam-style question together. A company reports the following: cash 50,000 rupees, inventory 70,000, accounts receivable 80,000. Now for liabilities. Accounts payable 60,000, short-term debt 40,000, taxes payable 20,000. So what is the working capital? How do we quickly and accurately extract this raw data without falling straight into any of those traps we just talked about?
Let's break this down step by step, beautifully organized just like our AI study buddy, Microsoft Copilot, would do it. Step 1, we systematically sum the current assets. So that's cash, inventory, and accounts receivable, giving us a total of $200,000. Step 2, we sum the current liabilities. That's accounts payable, short-term debt, and taxes, bringing us to $120,000. Step 3, we simply subtract the total liabilities from the total assets.
Following those exact steps, 200,000 minus 120,000, and boom! Our final answer is exactly 80,000 rupees. Nailed it! Now, an AI tool like Copilot isn't just some glorified calculator, it's an incredible asset for modern candidates. You can use it for fast, step-by-step problem solving to double-check your work. You can have it dig into dense annual reports to spot historical working capital trends. It's fantastic for interpreting complex ratios, linking working capital changes directly to cash flow from operations, and summarizing really heavy concepts for a quick revision session. Integrating AI makes your prep smart, fast, and highly practical.
And that brings us to our final section, Section 5, Pro Study Tips, focusing heavily on essential ratios. You absolutely must know these related ratios alongside working capital. First up, the current ratio. You calculate this by taking current assets and dividing by current liabilities. While working capital gives us a raw, absolute number, the current ratio gives us a relative measure of short-term liquidity. This is huge because it allows us to compare companies of drastically different sizes.
Need an even stricter test? Enter the quick ratio, calculated as current assets minus inventory, all divided by current liabilities. This is the ultimate stripped-down test of liquidity. We safely pull inventory out of the equation entirely because, frankly, in a real crisis, it's rarely easy to quickly liquidate stock without taking a massive haircut on the price.
Finally, we have the cash conversion cycle. This metric shows you exactly how fast a company manages to convert its inventory into actual cash in the bank. Do not skip this. The cash conversion cycle is a massive topic for the CFA exam because it reveals the true speed at which a company's operations actually generate the cash needed to survive day to day. Okay, let's wrap this explainer up with some major pro study tips to lock in your score. First, understand the why behind the numbers. Don't just blindly memorize formulas. Second, study working capital right alongside the current and quick ratios so you get the full holistic picture of liquidity. Third, always connect these metrics straight back to the cash flow statement, specifically operating cash flow. Fourth, analyze real-world companies like Asian Paints or Tata Steel. It cements the concepts like nothing else. And finally, leverage AI tools to think faster, but make sure the core conceptual clarity belongs to you. AI isn't going to be sitting in the exam hall with you.
So I'll leave you with this question to really chew on as you develop your analyst mindset. When you look at a company, are you just getting starry-eyed over the profit on the income statement? Or are you digging deeper to ensure the business actually has the working capital to survive? Because in the world of finance, survival always comes first, and a rigorous grasp of working capital is the only reliable way to prove it. Keep studying smart, and I'll see you in the next explainer.